India's Monetary Policy Committee has voted to cut interest rates by another 25 basis points. This is the third time in 2019 that they've cut rates. So the total rate cuts in the year go up to 75 basis points. The repo rate at 5.75% is the lowest in 9 years. This time around, the decision was unanimous, perhaps suggesting that the extent of growth worries within the committee have deepened. Joining us to talk about the state of the economy and the MPC's actions, Soumyakanti, Ghosh, Chief Economic Advisor at State Bank of India, and Abheek, Barua, Chief Economist at HDFC Bank. Thank you both so much for joining us. Appreciate you taking the time to speak to us. Mr. Barua, I'll start with you. The language of the MPC meet this time around certainly reflected what everyone else has been saying, which is that growth is weakening and that action is warranted.
Yes, absolutely. And I think I see sort of a slow shift in the RBI's, almost its basic avatar, which, is changing from an inflation obsessed central bank, which even when growth worries became intense, kind of soft pedaled on these issues and was solely fixated on inflation. I think we are sort of going back to the good old days, so to speak, where the RBI implicitly had multiple targets and growth was one of them. That took a bit of a back seat with this flexible inflation targeting regime and so forth. So I think on at a broader, big picture level, I think that shift is something that I have kind of noticed and I think is important.
Mr. Barua, that's an interesting observation. So I'll stay with you for one more question before I go across to Mr. Ghosh. What do you think has prompted that? If there is a change in their sort of, approach to how they're managing this growth inflation dynamics, then it's not just driven by the short-term slowdown.
Yes, well, it has to do with, ultimately, a lot of things have to do with individuals at the helm of things, and I think Mr. Das has brought back some of the concerns on growth because of his personal predilections. And I think over time, as a system of monetary management evolves, you begin to figure out where you've gone wrong, and clearly they've gone hugely wrong on the inflation projections in the past, and you kind of assess the costs of just focusing on inflation with often an inaccurate forecast, and then you kind of do a rethink and tell yourself that, look, maybe we should be looking at growth a little more closely, and perhaps there is something somewhat flawed about going with the inflation targeting thing, absolutely by the textbook. So I think all this could have prompted a sort of a change of heart or a change of perspective, if you like.
Interesting. Mr. Ghosh, in some ways that would be a validation of what you have been saying for a while, that inflation is not a problem and we need to switch and start worrying about growth because growth is weakening. You had expected a 25 or a 50 basis point cut, or maybe somewhere in the middle at 35. So you got 25 and you got an accommodative stance.
No, I think the 25 basis point rate cut and accommodative stance, I think it's some sort of a middle ground, because keeping rates, instead of cutting the rates by a larger amount, the RBI has decided to cut it by 25 and then cut by possibly more increments maybe in the next couple of policies. So that's specifically sort of a middle ground, and I believe and the verdict 6-0 in favor of a rate cut actually shows that the RBI is seriously concerned about growth. And even the RBI numbers, Ira, if you look into the very carefully, the RBI numbers which they have put out even after this so much discussion on growth, I think the numbers still are a little bit of overestimate, because in the first half of the current fiscal, none of us, in fact, we are not expecting a 6% plus growth in the first half, and 7.5% growth in the fourth quarter as of now looks a tad difficult. So on all accounts, growth could be even slower than what the RBI has projected. So, and given the fact that global economy is very, and as it's hurting towards an slowdown at an exponential pace every day. So, I think the possibility of more rate cuts has opened up. The only issue is that how do the RBI look into this liquidity management right now, and whether this stance will also help in deposit rates going down from the current levels, because that will be the key to the future cut in lending rates by the banks.
Sure, I'll come to that in a minute. Mr. Barua, what is your assessment of where the pressures on growth are coming from? We've all spoken about the rural demand issue. Is there any reason to believe that this, impact on demand is following through and going into the urban markets as well? Is that emerging from job losses which may not be documented? Are there other issues like the pace of, say, M3 growth, which some of your peers have pointed out, that are the root cause of this slowdown?
Oh, absolutely. And I think while the rural slowdown has been in place for a good couple of years, I think the urban slowdown is a little more recent. And it seems to have coincided with the sort of the big blowout in the NBFC sector. So while I think some of the points that you raised explaining the slowdown are true, it's also perhaps exacerbated by the lack of availability of credit or leverage to a certain very critical category of consumers who were driving growth at the margin, and where demand and a number of items was not saturated. So I think that has also played a role. And while I think the rural slowdown could it might have kind of run its course, and you might just see some improvement if there is better management of the food economy, including better realizations for farmers. I think the urban slowdown has just about started, just about 7 or 8 months old. So I think we need to worry about that quite a bit. And I think this NBFC piece, which is very much an element of that.
Mr. Ghosh, in your last report, you had pointed out that the indicators are now pointing very clearly to not just a rural slowdown but an urban slowdown. Would you agree with Mr. Barua that it's largely related to the NBFC piece? This question was not asked to the RBI this time, nor was this chart there in this time's policy. But last time around, they continued to assert that the overall flow of funds is still higher in FY19 compared to FY18. So they seem to feel that bank credit is substituting for NBFC credit.
No, that is that is one of the arguments, but just to put the things in proper perspective, I'll give you two figures to give you the extent of what impact the urban slowdown has now begun to happen. In March 18, when the RBI had published the data, the last published data of the NBFC after the September 18, March 18, the NBFC disbursement to the auto loan sector was at a staggering 61%. Today that number perhaps could be negative. And the other thing is that if you actually look into the NBFCs, the holding of cash equivalents of the NBFCs, we did just a simple estimates and found out that there has been an increase in 55% of their cash equivalents in the last 6 months, from September to March 2019, of which the data is available. That means that the NBFCs are holding on to the cash, and it's not that all NBFCs are disbursing, but there are majority of the NBFCs are actually become very cautious, and possibly the carrot and stick policy which the RBI has recently adopted in terms of having a better ALM mismatch, that is working. And my sense is that it's more of a solvency issue, and because fund is flowing to the better rated NBFCs, and those NBFCs which are actually backed by government. So it is happening, but the point is that the not the so better rated NBFCs are getting the funds, and at some point of time there will be some consolidation in the sector, and I think this problem is not going to go away in a hurry. And any sort of an action, for example, an AQR action or something could actually elongate the pain in the system, and I am not sure whether the system could endure such a pain at this point of time when the growth has almost bottomed out in the system. So we have to have a very carefully adopted, calibrated policy. I am not sure whether there will be a lending line to the NBFCs, because That's not the way to look into the problem, because there is a risk taking and risk on behavior on the part of the NBFCs, and it's time that we now distinguish the good rated apples from the bad rated apples. For that, the system will have some churn, but that is a necessity for any financial system to be robust going forward.
Abheek, are you comfortable with the way they have handled the NBFC issue so far? Again, today they sort of seem to reiterate that they're not particularly keen to jump in and save individual NBFCs, etc. But then the system will pay the price, as Mr. Ghosh was pointing out.
Yes, so I think it's again this trade-off between long-term hygiene and short-term sort of pain in the short term. And my sense is that given the fact that we've just sort of not really come out, but I think we've temporarily seen some dissipation of the crisis in the banking sector. Another severe shock to the financial system, and remember, NBFCs are not really that as a whole are really not that small a part of the financial system. I think I personally thought that we could do with a little more empathetic handling of the sector. But I was kind of encouraged by what Mr. Das had to say today, because it was sort of like Draghi said, anything to do to save the euro. So his comments were on the lines of Dr. Draghi's statements that anything to save the NBFC or NBFCs or a particular NBFC from imploding. So perhaps they have backstops in place, but they will not show their hand, because that would lead to moral hazard kind of issues. But I'm sure they they realize the costs of letting things fall off a cliff at this stage, both of growth and of the degree of confidence in the financial system.
Sure, no, he did say that they'll do whatever is required to ensure financial stability. The one thing that, has changed, and I'm sure the markets will be thrilled about it, Mr. Ghosh, is that liquidity is in surplus now, at least for the last few days. And presumably the RBI will allow it to at least remain comfortable, maybe in a mild surplus. That should allow for transmission, at least to the bond markets, which has already happened, and then eventually to the banks, perhaps?
No, I think it's a good point, Ira. I think liquidity in the past also, you have said, if you take the examples from 2015 onwards, even though the demonetization was a structural break, but if you actually slice and dice the data, we'll find that whenever the liquidity has been in a surplus place, there, of course, the money market rates have declined. How much, but it's a matter of still debate how much the money market, the yields have actually declined, reflecting the real economic scenario. So even if I discount that, I think transmission will happen, but to me that still remains an issue, because we have just recovered from a 3 lakh crore currency withdrawal in the last year. So and that 3 lakh crore, it depends on what is the amount of that money which comes back into the system. So even if the system remains in a surplus mode, it will of course help in transmission, but I still believe that the deposit rates will be, any decline in deposit rates will be gradual. It could be even slower and not as per the market expectations, because at the end of the day you are having a scenario where you have to fund a credit growth and where the deposit growth has been significantly lagging. So if that is the case, it's very unlikely that deposit rates could see a significant downturn, and if that is the case, I think the transmission will be slow, maybe steady, but it will be definitely slow.
Mr. Barua, should this transmission happen, and do share your thoughts on whether you think it would pick up now the pace of transmission, then 75 basis points cumulatively is a significant amount of monetary stimulus to the economy, right?
I think it is, yes. But there is a question of transmission, and I think the governor was a little more optimistic about transmission, and of course backed by the data that he has. in terms of looking at new loans given, where there's been fairly significant transmission and so on. And I think transmission is a slow process, and we have both structural impediments to transmission in the form of rates and small saving schemes and so forth. And I think a lot of the transmission really is aided and abetted by competition from things like commercial paper. So if you have a large amount of disintermediation, banks face that heat. Companies start going to the market to pick money up instead of coming to the banks, and then banks do a rethink and say that, hey, let's drop our rates and compete with things like commercial paper. And I think, again, I go back to the NBFCs. If you look at the NBFC mutual fund piece, especially the fixed income mutual funds, the shorter duration fixed income mutual funds, which were really funding these CPs, those have seen a huge decline in flows because investors are very worried about where the money is going, and consequently the flow of money into the CP market, except in really high quality CPs, has also diminished. And consequently, what you don't see now is the kind of competitive pressure coming from disintermediation, the market itself, and companies or borrowers going directly to the markets. I think, again, unless that is reversed to some degree, we will see transmission proceeding at a somewhat measured pace. Although I think keeping the system surplus for a good period would certainly aid transmission more than having a neutral or a deficit situation.
Right, interesting points there. I just want to switch focus a little bit. Mr. Ghosh, I'll start with you. There was no talk on the fiscal side in the policy. How comfortable are you on the fiscal front? I think we've all been raising issues about some of the borrowings which seem to have been passed on to the balance sheets of entities like FCI, etc. The governor seemed to shrug it off, Mr. Ghosh. Is that not something we should be worrying or at least looking at carefully?
No, I agree with you. I think, for example, with the numbers which has been announced on the fiscal numbers, I think right now we made an estimation and found out that the tax revenue actually need to expand by close to 30% if we have the same interim budget numbers which was projected in February 2019. Now, having said that, so therefore, if the government stays on the course of a 3.4% deficit for this fiscal also, for FY20 also, which they have said in the interim budget, I think then the tax revenue, as I have just said, has to need to grow at an astonishing pace of 30%. Otherwise, what is likely to happen is that, as you know, 70,000 crores of food subsidy was taken off of the budget, and that was put into the off-balance sheet activities. So my sense is that either the government clearly says stays on a transparent, creditable and achievable fiscal deficit or consolidation path, or it says that, or it keeps the deficit at a higher level, and the markets actually will be happy with that, because if tomorrow the government says we're going to hit 3.4% next year given the current revenue numbers, the markets will take that number with a pinch of salt. However, if the government actually goes ahead with possibly an enlargement of the fiscal deficit by whatever decision it takes, that would actually be welcomed by the market, because then there will be a clear indication to the market that, look, we are not comfortable with this number, so we are projecting a higher number, but we are assuring you that we will go beyond the path of the fiscal consolidation and growth comes back into the system. But if we are on this path of fiscal consolidation, then all these off-balance sheet borrowings activities is actually adding a lot of non-transparency to the budget estimates. So my sense is that no harm in giving a fiscal deficit number which could be higher than what they had said in the interim budget, but then it should take care of all this non-transparency which is happening. Just to give a very small example, a few days back New Zealand announced a budget whereby they have created a new head of well-being budget. That means they have put all the social expenditures under that head. So why can't the government be transparent and say that, look, we are doing all these social initiatives and putting this under one bucket? Because this is what the market wants, some definite communication in terms of the deficit numbers, which is achievable and credible.
Interesting. Mr. Barua, how do you analyze the fiscal side of things? You know, the 3.4% number tells you, okay, fiscal consolidation is well in place. The other numbers suggest they're not. On the flip side, there are those who are arguing that right now, with the economy where it is, maybe some fiscal stimulus would actually help quicker than monetary stimulus.
Yes, but I think the market borrowing numbers, despite fairly heavy reliance on the small savings pool, is fairly high, and sort of a significant addition to this will lead to a rise in yields, which might actually again lead to a problem of demand and so forth. Although I tend to kind of agree with Soumya that keeping the fiscal deficit or announcing willy-nilly a fiscal deficit number which looks good, the optics are fine, but there is a fairly obvious incentive to resort to all kinds of jugglery and off balance sheet stuff and so forth. Maybe without credibility, a fiscal deficit number is worth very little. Or in general, this is a somewhat unrelated point, is that I thought the discussion on any of the inflation pressures, particularly the fiscal deficit situation, was rather weak and tame in this in this monetary policy, because we've gotten used to policies where any kind of accommodation of growth was had 100 riders attached to it in terms of possible risks to inflation emerging from different sources. And where there are two clear risks of inflation, one is of course this the fiscal situation, which is known to be inflationary given the severe capacity constraints we have in certain sectors, and also the possibility of a weak monsoon. I thought the entire inflation thing got short shrift and sort of didn't get the kind of attention that a central bank monetary policy announcement should have. So yes, I mean, I thought they could have spoken a little more about the fiscal risks, because I think they are significant.
No, I'm glad you mentioned that. I was going to come to the fact that we're talking least about inflation in a monetary policy discussion, which sort of shows how priorities have shifted. Mr. Ghosh, let me start with you on the inflation side. They did say that food price uptick has been a little steeper than expected, but then they balanced that out very quickly by saying that the core inflation numbers have softened significantly, which is obviously a fallout of the demand conditions. You're fairly convinced that this whole fiscal year inflation risks remain pretty much at bay?
Yes, so we remain that. And regarding the food inflation also, Ira, I think the food inflation is actually from the mandi prices have been now higher than MSP prices, but there has been actually a degrowth from the MSP from the wholesale to the retail. So that trend has actually now been broken for a consistent period, and possibly it is because of the RBI, the inflationary expectations is becoming less entrenched. So from that point of view, we are not bothered about inflation. Our only sense is that the inflation numbers for the fourth quarter of the current fiscal year as per the RBI could be a little bit of underestimate. We are looking at a number which could be a tad above 4% or just close to 4%. But apart from that, we are largely comfortable with the RBI inflation trajectory forecast for the time being, and who knows that given the negative surprises, the positive surprises the inflation has given throughout the last 2 years, the numbers could actually be even lower than what the RBI has put forward.
Abheek, let me just wrap up the conversation with the last question to you then. So what does the rest of the year to your mind look like? Average growth of about 7% odd, inflation of about 3.5% to 4%, and a repo rate of somewhere between 550, 575 if one builds in the additional cut that most are predicting.
Oh, absolutely. You've sort of summarized it very well. So thank you.
All right, I'll leave it there then. Mr. Barua, Mr. Ghosh, thanks so much for joining us here on Bloomberg Quint. That's Monetary Policy Day. One more committee meeting done, 75 basis point rate cut for the year so far, 25 announced today. Thanks for watching Bloomberg Quint.